In this week's video, we'll cover a seismic shift in market expectations and ask, what could it mean for stocks? Order of operations, we'll cover the rare shift and then we'll tie it into calendar year 2016, and then we'll close with a handful of update charts from 2016. The shift that we'll be covering in this video has only occurred two other times in the past 25 years. In the two previous instances, big moves followed in the stock market. This really isn't a signal, so there's no need to send small sample size tweets or emails. This is a story about central banks, the economy, perceptions of risk, asset class behavior, and economic common sense. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The upper portion of this graph here is one of the risk-on, risk-off ratios tracked by the CCM market model. This line on the top here is the S&P 500 relative to the volatility index, or the VIX. We said there are some useful ways to leverage the VIX, and we believe on our time frame this is one of them. This looks very, very confusing here with all of this movement. How could this possibly be helpful? Rather than bore ourselves to tears with the math related to volatility, let's try to simplify things with some visuals. The lower portion of the graph is the S&P 500. This is 1991 on the left side of your screen, and the present day in 2016 on the right side of your screen. Obviously, buy and hold would have worked really well from here to here. Then some defensive measures for several years in here. A new trend in the S&P 500. Buy and hold would have worked extremely well. Then buy and hold wouldn't have worked well at all in here during the financial crisis. And then we have a new long-term trend here, followed by some sideways consolidation for a long period of time, taking us up to the present day. How can this risk-on, risk-off ratio used by the model help us with this? If we remove the volatility from the upper portion of the graph and simply focus on the trends, this is point to point for the risk-on, risk-off ratio, point to point, point to point, point to point, and point to point. We can see for the most part, on a long-term basis, the ratio of the S&P 500 relative to the VIX zigs and zags with the stock market. Point to point, the ratio is in a long-term uptrend. Point to point, the S&P 500 is in a long-term uptrend. The ratio peaks, the S&P 500 peaks. The S&P 500 bottoms, the ratio reverses as well. We get a peak in the ratio here, and in this case, it's a little bit early, raising some yellow flags here, and eventually the S&P 500 gets in line with the ratio and falls as well. The ratio starts to show bullish signs early in 2009, starts a new uptrend point to point here, and here is the point-to-point move in the S&P 500. So you can see from a trend and a long-term perspective, this risk-on, risk-off ratio can help us with volatility to ignore, volatility to respect, volatility to ignore, and volatility to respect during the financial crisis. Before we add an indicator to the mix, we should note we're looking at monthly charts. In this exercise, we're going to use MACD, which is a momentum indicator from Market Wizards. Markets operate more on psychology than fundamentals. We're using this more in a visual manner here than a mathematical manner, where we're looking at bullish conviction relative to bearish conviction. So you can see here in 1998, for the most part, the S&P 500 is in a bullish uptrend here. And for the most part, my MACD here is for the ratio above, is also bullish. MACD really gives us two types of signals. When the black line here is above the center line, so the center line is 0 here, it says that our ratio is in a long-term uptrend mathematically for the most part. Conversely, when the black line drops below 0, it's telling us that our ratio above here would now be flipping into a downtrend. The other signal from MACD, when black is above red, all things being equal, that's telling us that momentum is positive and favorable, and when black drops below red, it's telling us that momentum is starting to wane and is much less favorable. So think of it this way. A full-bore bullish look for MACD is when black is above red and when black is above the center line. That tells us that we've got a bullish trend because we're above the center line, and we have positive momentum because black is above red. Conversely, a full-bore bearish look is when black drops below the center line and we have a negative trend, and our black is below red and we also have negative momentum. So when the S&P is rising from 1998 into the peak into 2000, you can see for the most part, we have a full-bore bullish look for MACD. This MACD is for the ratio of the S&P 500 relative to the VIX. And when we get the bearish cross on MACD telling us the momentum is starting to wane here, the S&P 500 has already peaked. And eventually in the bear market, we move to a full-bore bearish look. Weak momentum and a bearish trend, bad things happen in the stock market. So to summarize, before we move on, a good look is black above red and black above the center line. A bad look is black below red and black below the center line. Good things tend to happen, bad things tend to happen, and MACD can help us with that. As we move on here, it's important. This MACD is for this risk-on, risk-off ratio. We're not looking at MACD for the S&P 500. We're looking at MACD for the S&P 500 relative to the VIX. So this MACD aligns with this ratio above. And you can see here the trends too. When stocks are doing well, the ratio is moving higher. When stocks are not doing particularly well, we have a downtrend as we showed previously. If you know your market history, you know the dot-com bear market actually ended in October of 2002, but we retested those lows in the spring of 2003. So from a mathematical perspective, the entry point, the really favorable entry point, came in the spring of 2003. You can see here, May 2nd, 2003, we get black above red here. It's starting to turn up and it's moving back towards the center line. This is noteworthy here. This is a bullish cross here. However, it occurs below the center line. That's telling you this is the higher probability that the move in the ratio is a counter trend rally. Why? Momentum is improving with black above red, but black is still below 0, telling us we're in a downtrend. And sure enough, the ratio went on after this rally to make a lower low. So this move here, you would also look at with some degree of skepticism. You're not full bore bullish here because you're just checking one box. Black is above red, telling us the momentum for this is improving. And the S&P 500 also has a troughing type look. Here, this blue line, and we'll use this as a reference point throughout these examples and bring it all the way to the present day. It's where the black line is here on May 2nd, 2003. What MACD can help us with here, this is somewhat bearish conviction look here, weak momentum and then a weak trend. This is a bullish momentum look, and then we get the bullish cross here above 0. So now in 2003, we move to a full bore bullish look with MACD with black above red and black above the center line here. To get to this point here, the upper blue line, so from point A, where we hit this blue line here, to point B, to get this somewhat of a sentiment momentum shift of this magnitude, and this is a big move and a big shift, it took 623 calendar days to get from this line here to this line here on MACD. The chart we're looking at here, the S&P 500, it's as of January 14th, 2005. On January 14th, 2005, the S&P 500 was trading at 1184. after this positive and significant momentum shift, think of it as a sentiment shift, I think we're in a bear market is what this looks like. This is, we may be moving to a bull market, and here we've got a full bore bullish look. We are now in a bull market. Think of it somewhat as a barge. It takes a long time to get the net aggregate opinion to shift from bearish to bullish, and in this case, to get from point A to point B, it took 623 calendar days. So what happened next after the move from point A to point B on MACD? The answer is that bullish and positive momentum enabled the market to move from 1184, which is point B, January 14th, 2005. Here's the S&P down here. After we got the move from A to B and we've moved to a full bore bullish look on MACD, the S&P 500 gained an additional 32%. So this turn in momentum enables really the bull market to start in full force in here. Somewhere in this area here is where everybody is saying this is starting to look like a bull market. And after that, we move 32%. If you're watching at home, you may have also noticed that MACD is starting to look pretty shaky here for our ratio in 2007. The stock market is still rising into 2007 October. This is the S&P 500 here, but look how ugly the ratio looks. The ratio has waning momentum. This is a bearish cross now for momentum, black below red, but it's still within the context of a rising trend here. When we go below the center line, now we've got a full bore bearish look from MACD, telling us you better be careful about the S&P 500. What happened next? After we got the full bore bearish look, so two things have to happen. Black below red telling us that momentum is waning. Black below the center line tells us that we're now in a downtrend in our ratio. After that, soon thereafter, the S&P 500 peaked here, and it dropped from 1565 down to 666. This is a 57% loss, and that happens after we can see these signals here. This is observable. I can see it before this happens here. When this happens, it doesn't tell us we're going to drop 57%. It simply tells us that the probability of good things happening is lower here than it was here. This looks much, much better than this does here. So this is an improving look here in calendar year 2003. This is a deteriorating look here in calendar year 2007 for MACD monthly on the ratio risk on, risk off S&P 500 relative to the VIX. After we get the improving look, after that, good things happen in the S&P 500. After we start to deteriorate, bad things happen in the S&P 500. Now we're moving all the way to February 19th of 2010. If you know your market history, you know we bottomed on March 9th of 2009. On February 19th, 2010, we had moved back to our blue line that we've used as a reference point in the past. These are the same two blue lines that we were using for A to B. So now we're back to level A here. We have an improving momentum look, but we still are below the center line here when the S&P 500 sits at 1109. Remember when we had the improving momentum look here in 2003, good things happened. Now we have an improving momentum look here in 2010. Remember, these are long-term signals. The model is diversified. It uses numerous time frames, daily, weekly, monthly, are what we rely on for the most part in the calculations. So this would be one of the later signals to confirm the signals that we would already have on daily and weekly charts. So in this case, to get our A to B move from February 19th, 2010 to February 1st, 2013, it took 1,078 calendar days to get that type of magnitude on a momentum shift. So almost think of this as, again, the barge. We're in a bear market. The barge, momentum barge, starts to turn, And at this point, almost everybody is on the barge here in 2010 from a long-term perspective. And you get somewhat of a significant shift in sentiment, and that net aggregate opinion is shifting and turning like a barge here. It looks negative here, and it looks much, much better here. So we remember here at point B, good things happened after it. What happened after we reached point B here when the S&P 500 was trading at 1513? The answer is that momentum surge enabled the market to eventually move from 1513 to 2134 as of May 20th, 2015. So that's a 41% gain, an additional gain after this type of barge turnaround that we have here. How can all of this potentially help us with probabilities in 2016? Let's fast forward to February 11th, 2016. This is a deteriorating look here. Black below red. Eventually we go below the center line. Full bore bearish look, and after that, more bad things happen in the S&P 500. Notice where the cross comes here. The cross comes here early in this case. Then you get your negative move below the center line here, and then really bad things happen in the stock market. February of 2016, we have a very similar look. Here we get the negative cross and momentum, and eventually here in early 2016, we are clearly below the center line. Now we have a full bore bearish look. Our barge is starting to turn as it was turning here and as it was turning in here, and after that, bad things happened. So you can understand why many seasoned money managers were defensively positioned with this type of look here in February of 2016. Why? Because this is what happened the last two times we had a similar look where the barge had turned from the net aggregate opinion was bullish to the net aggregate opinion was bearish. What could have possibly shifted this type of move in the barge here? Well, the most logical candidate would be the Fed, and we've covered this in the past. It's the shift from the central banks. January of this year, they're talking about raising rates 4 times. By the time we get to June, Yellen is talking about the need to put helicopter money into their toolkit. So once the Fed started to back off of their normal late cycle script, something that we covered in short takes, July 18th short takes, in terms of what's changed. The short answer is everything we have come to know over the past 20 years about the latter stages of economic, interest rate, and market cycles changed in early 2016. That is a strong statement. Everything we have come to know. The shift is clearly evident in the odd behavior seen across numerous asset classes, which the tweet captures. Here's the tweet. The S&P 500 has never been at an all-time high when the 10-year yield was an all-time low. Never. Somewhat saying we were at maximum confidence and maximum fear on the same day. What could possibly have enabled something like that to happen? Central banks. And the MACD for our ratio is going to help us back up this statement, a strong statement in July of this year that says everything we have come to know over the past 20 years has changed. So moving back to our look on February 11th of this year, if we flip forward to February 19th, we actually get the monthly MACD on the A line again here and on the A line again here. So we have momentum that's fallen down as low as it was here, fallen down as low as it was in this region here, and we're at a similar level on February 19th of this year. We still have the full bore bearish look with black below red, and now we're moving into a downtrend with black moving below the center line. Keep in mind, it took 623 calendar days to turn around the barge after the dot-com bust. You can see the barge turning around here. it took 1,078 days to turn around the barge from here to here, a similar shift from point A to point B. And after that, good things happened in both cases. After the 623-day move, the S&P gained an additional 32%, and after the 1,078-day move from point A to point B, the S&P 500 tacked on an additional 41%. Why did we use the term seismic shift at the beginning of this video? Well, in this case, it took 216 calendar days to turn around the barge. So think of it this way. Down here, the net aggregate opinion is clearly in the bearish camp. This time, to turn the barge around, and if you're going to turn that barge around in 216 calendar days, this is almost 5 times faster than it took in this case here. Something dramatic had to happen. And from a probability perspective, after something dramatic happened in these cases, additional gains in the stock market followed. What could have turned that barge around so quickly, so much faster than this case here and this case here? The short answer is everything we have come to know over the past 20 years about the latter stages of economic, interest rate, and market cycles changed early in 2016. This shift is clearly evident in the odd behavior seen across numerous asset classes, which the tweet captures. Like many of the other charts that we've looked at in recent weeks, we can ask ourselves, the current look of this MACD here, does this look anything like the peak before the financial crisis? No, it does not. Does it look anything like the pre-plunge period or during the plunge in 2011? No, it does not. Does it look anything like the early stages of the dot-com bust? In its present form, it does not. And the next question would be, does it look anything like this bullish turn here in 1998? Does it look anything like this bullish turn here in 2003? And does it look anything like the bullish turn in 2009? The answer is yes. In many of these instances, the black MACD line drops below zero. It goes from a bearish momentum look, to a bullish momentum look, and then it eventually crosses the center line. It goes from a bearish momentum look to a bullish momentum look, and it's crossed the center line. This analysis and these charts don't tell us anything about the future. They cannot forecast the future. They simply speak to probabilities and improving probabilities. As long as the charts look this way, which can be said for any chart, as long as the bullish setups that we have remain, then they're meaningful. We have to be open to change. The bull-bear barge turning around here is also encapsulated in other things that we have covered in the past. For example, early in 2016, asset class behavior, silver relative to TLT. This is a deflationary look. Then the Fed flips the script and takes the old late cycle script, throws it in the trash can, and starts talking about a new script. SLV, silver relative to TLT, turns around. This is a bullish look here, similar to this look here. In terms of the fundamental reasons why the Fed has ditched the typical late cycle script, we've covered those fundamentals in this video here. Remember our kale smoothie economy video? If you haven't seen it, you can Google this title. You should be able to find it. We've also written in the past about what a typical interest rate and market cycle looks like, and that the Fed is really trying to engineer a bottom at a top here, and they're flipping the script, and this is the look of what they're trying to create, the new late cycle Fed script. You can find these charts and more detail by Googling the same title. This title here, where my cursor is, can take you to a video and a post. There's a post that has text and the video using this title here. Does this A to B move in MACD here align with anything else? Yes, we have observable shifts and observable evidence that we've covered in this video. You can Google the title to find it. In this case, we were looking at weekly moving averages. In this case, we covered daily charts. You can find the analysis by Googling this title here. We chose to cover this risk-on, risk-off ratio and monthly MACD this week because it helps us illustrate big picture weight of the evidence concepts. This A to B move in MACD in isolation is not particularly useful or even meaningful. We don't use it, we don't care about it, and we haven't back tested it, and we don't consider it to be a signal. As clients and regular viewers know, we make decisions based on facts that we have in hand. The facts that we have in hand currently align with this rare occurrence and the economic story that we've outlined in this video. This video and everything we do and the market model, it's all about current probabilities based on current facts. This video is not about forecasting. When we forecast, we tend to bring the human ego into the equation. We would prefer to avoid doing that. Since we're looking at current probabilities and current facts, if the facts change, we will remain flexible enough to allocate based on the new information. This is an updated version of a weekly chart that we've been covering in recent videos. This is as of the close on Friday, September 23rd. 2 weeks ago, we talked about the math classifying this plunge thus far as volatility to ignore. Mathematical common sense probably tells us that the odds are good if the stock market went up 11 points the week after the plunge. It tacked on an additional 25 points this week. If those two things followed the plunge, and the math looked pretty good here, then the math probably still looks pretty good, and that is the case as of Friday, September 23rd. We had the big drop on a Friday. The following week, the S&P gained 11 points, and this week, over the past 5 trading sessions, we gained 25.5 points. The math, big picture-wise, looks good. We're still near this box here. We're on the right side of it, and it's possible that we could move into this area here. Recent videos have talked about the fact that when you break out of a box, there's no law that says you can't come back into the box. As of the close on September 23rd, this chart and the gain over the last 5 days, all of it still looks pretty good. Is there anything else that aligns with the Barge turning around in the VIX analysis that we've covered in this week's video? The answer is yes, asset class behavior. You remember back on July 22nd, we talked about how could it be possible that bonds, stocks, and gold were all moving in unison. Well, that fundamental story here is still in place. After the Fed, the same thing happened. They moved in unison for 2 days. So the story, the narrative around this appears to be in place relative to supply and demand in the markets. Are there things to worry about in 2016? Absolutely, positively, yes. There's always things to worry about. Valuations come to mind in the present day. Therefore, fair question. What happens if the central banks fail to engineer a bottom out of a topping formation? For us and under our system, the answer is fairly simple. If the central banks fail, it will show up in the hard data. We know this is an ugly look here in 2007, 2008. Ugly look, early stages of the dot-com bust. And this is the chart that we covered on September 9th. This is the intermediate term trend. This is the longer term trend. If central banks fail, all of the data tracked by the model on daily, weekly, and monthly charts will begin to deteriorate. At this time, that has not taken place in any shape, form, or fashion. In fact, if we look at the same chart As of the close on Friday, September 23rd, even with the market down on Friday, September 23rd, it was up and positive for the week. We can see that the present day look and the observable evidence and the facts in hand, this look here looks nothing like the early stages of the financial crisis, nor does it look anything like the early stages of the dot-com bust. Is it possible that we morph into a look like this? Absolutely, positively, yes. And if we do, the data within the model will catch it and we will adjust as needed. Right now, as of Friday, September 23rd at the close, the data is unequivocally, the weight of the evidence is in a hold our positions mode. All of our positions are scoring well. We're keeping a close eye on things. Obviously, all of that is subject to change, but it hasn't changed yet. So as always, we'll head into next week with that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.